Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. We've just completed video number 1 with Mr. Dan Bird, where we talked about last week. We painted a vision of next week. And right at the tail end, he teased us with something that he wanted to share from his newsletter around the 200-day moving average. So, Mr. Bird, the floor is yours.
Great. Let me start. I'll show the newsletter again. Let me share my screen first. And if people are going straight from the last video to this video, then it's going to be repetitive, but that's all right.
Yep.
If anyone's interested, I do a newsletter every Saturday, usually, really for my own research, but I put a lot of the information that I've discovered and I put it into an email and sent it out to, started with my friends and family, and now it's expanded to your listeners as well.
Which is so awesome. They love it, by the way. I get feedback all the time. They're very appreciative. Thank you.
Yeah, I get a few emails from folks, which is encouraging to hear.
Yeah.
I mean, it doesn't really matter if they like it or not. I'm going to do it regardless.
But it does feel good.
It feels good, sure.
Come on.
Yes. And if they don't want to get it, just send me a note.
You'll take them off. No big deal.
No big deal. It's really easy to add or subtract from a distribution list.
It is.
There's not much effort involved in that.
There you go.
So anyway, breakpointtrading@gmail.com is the email address. And I'll send out this past week's newsletter and then add folks to the distribution lists for the next week's coming.
Okay.
So before I get into this next topic, which is all about the 200-day moving average, I'm gonna go to my desktop.
Okay.
So I put this in the newsletter as well.
You did, yep.
And I suggested that people put it, either print it out, put it on their wall, or put it on their desktop. This is how I have it. It's just on my desktop all the time now.
And I love number 1. Always be with the predominant trend.
That's the one we're going to talk about.
That is awesome.
So Paul Tudor Jones has been a very successful trader for many, many years. These are really excellent rules, trading rules. And if you can stick with these rules, then he will eventually succeed at trading. You never stop learning. So there's always something new that's coming up, just like last week when we had 1,000-point drop on the Dow, and I was in some stocks, and you should always have a stop. So you know ahead of time where you're going to get out before you open the trade.
Yeah, that's really what you've taught me. Again, if people go back to your playlist and some of your early videos, you brought to us, what do you call it? Your risk
calculator.
Risk calculator. You've helped me do that. It's gold. The stops are gold. So thank you.
Yeah. So it's all about sizing. Don't bet the farm, because you never know if you're right or wrong. And always put a stop on it. So I got stopped out of a few things Friday.
You took some losses.
And I took some losses, but they were small losses. Yeah. Which is and now I still have most of my portfolio available and ready to trade if I see the market starting to go back up again.
There you go.
So a lot of these rules are really excellent, actually. So I put it on my desktop just like this so I can always look at it.
That's awesome.
Every morning when I bring up my computer, this is what comes up. And I might go through and read a few each day and, decrease your trading volume when trading poorly, increase when trading well. Yep. Some people start, they lose
double down.
Trades,
yeah.
And they do revenge.
Go harder.
Trading.
Yeah.
Revenge trading.
Not good.
I'm going to double the number of shares and make back what I lost.
I'm going to make it up. No.
Where in reality, you should do the opposite.
I like that.
So I love this one. Every day I assume every position I have is wrong.
Oh, love that. How many of you out there think you're always right? Yep.
Yeah, exactly. I know where my stop risk points are going to be so I can define my maximum drawdown.
That's awesome.
So important. So anyway, we're going to talk about this whole idea. I was thinking about this, and I actually read just a quote in a book that I was reading about moving averages. Okay. There was a quote from Paul Tudor Jones, which is why I went out and found this, that he said, I always, and it's number 1 on his list, always be with the predominant trend. My metric for everything is the 200-day moving average. And the other quote I saw, it went on to say, if it's above the 200-day moving average, I will buy it. if everything else looks good. If it's below the 200-day moving average, I will not buy it no matter what. And if it goes from above to below, I'll sell it immediately.
There you go.
So it's all about the predominant trend.
I love those crisp rules. I deal well with crisp rules like that. That's awesome.
Right. So I was thinking about that, and what I did was actually, it's on this slide right here. So what I did was, just out of curiosity, I took the S&P, went back to 2009, which is the beginning of this uptrend, right? And I identified, I said, okay, when it goes below the 200-day move, when it closes below the 200-day moving average, then that's my sell signal.
Okay.
But when it goes above the 200-day moving average, I actually want more confirmation that the trend has changed and going higher.
Okay.
So I'm going to wait till the 21-day moving average is above. In this case, it's actually the 50-day.
Okay.
Is above the 200-day. All right. So I just went in and I looked at each one of these where that happened, and I calculated what would have happened if I had just bought and sold based on that rule alone. Okay.
Okay.
So buy, sell, buy, sell. These are the aggregate wins or losses. Okay. Only one of them was a loss, and one was zero.
Got it. Yep, I see that.
But over this whole 13-year period, starting with 100 shares, which would have been $90,000
in this example, yep.
And you would have sold right here. By the way, it's never gone back above the 200-day, so you would have sold here in February.
Yeah, you're out,
and would not have been back in this market.
Okay, so you would have been up. What is that?
323, 300 up to 290,000.
Okay.
323% over 13 years, or about 25% per year.
That's what I was looking for. Compounded is 25% a year. Okay.
Right.
That doesn't suck.
Yeah. And it's only 8 trades.
Oh, it's 8 round trips.
It's only 8 trades.
Oh, 8 trades.
Buy, sell, buy, sell. There's one.
Oh, okay. Yeah. So round
2,
trips. Yeah.
3,
got it.
4, 5, 6, 7, 8.
8. And you're out. You're sitting in cash right now.
Yeah. Over 13 years. You've only bought and sold 8 times.
So this is the S&P.
This is the S&P. Yeah.
What is that? It's often called the SPYs.
The SPY. Yeah.
Yeah.
This is the S&P, but the SPY is the ETF that you could buy.
Right. Okay.
So the SPY is the ETF. The triple Qs is the ETF for
the NASDAQ. Yeah.
For the NASDAQ. Right.
Okay. 8 trades, simple in outs. Okay.
Yeah.
That's pretty cool. Paul Tudor Jones for the win.
Right. So let's see. Here's over 18 months. This is the 18-month one. Let's look at a longer period. Okay, so this is the same 13-year period.
Got it.
This is for the S&P, but we could do it for the Qs. If you'd like to follow the NASDAQ. Basically the same idea. So you would have been in here. You might have got out right here. So this is a little bit of a whipsaw possibly here.
Okay.
Out and back in, maybe out and back in. And then you would have followed it all the way up to here. Would have been out in 2015. And then back in here, all the way up here again. Out in 2018.
Yep. Back in. Yeah.
Out for the COVID crash, obviously.
Yep.
Then all the way up here. So same concept.
Yeah, that's interesting. Okay.
And if you look at it on a weekly basis, so this is a weekly chart.
Right.
So you kind of see it a little bit.
A little easier,
yeah. Takes a little bit of the noise away.
Yeah.
So again, same idea. So very few trades, and you're just basically using the 200-day moving average as your guide. 40
trading is that simple. What am I doing? Come on.
It can be that simple. So when you work through a broker and you buy a mutual fund, mutual funds are trying to beat the S&P,
right?
But they rarely do.
Yeah.
Right.
Yep.
And when the market starts going down, your broker, when you call your broker, you're panicked.
Yeah.
He says, don't worry, just
don't
hang in
sell,
there.
dollar cost average, buy the
Don't
dip.
sell. It'll all come back. Of course, it does, but you've lost that period and you've lost the money for that period, right?
Yeah.
So yeah, you could buy here and not sell ever.
Yeah, the Warren Buffett "don't bet against America" strategy.
Yeah, but this period right here is the secular bull market.
Right. Correct.
So I didn't look at this for the 2000 to 2009 period.
Oh, that might be interesting for next week.
Which is the bear market.
Yeah, that might be interesting.
But if you just did this, and use the triple Q. Let me do the Qs on this one on the weekly. So there's the Qs for the NASDAQ. The Qs are and the SPY are ETFs.
Correct. Yep.
So you can trade in and out of those just like a stock.
Yep.
So you don't need your broker to do it for you. You could just trade the ETF for the triple Qs and just make it easy.
Yeah. And right now, both of them are below the 200-day.
Right now, they're both below. And interestingly, the triple Q came up right up and hit that red line is the 200-day.
Right. Kissed
or this is the 40 week because I'm looking at a weekly chart.
Okay.
So 40 weeks is the same as 200 days.
Sure.
Right. So it came right up and touched it and then got rejected.
Yeah.
So if you were using that rule, while everybody was excited about this rally, you would have said, well, I can't buy because it hasn't gone above the 200-day yet.
There you go.
So you still would be out. You would have been out in February of this year and you would have still been out.
Yep.
Now it's, as a trader, if you like the excitement of trading every day or trying to pick a stock, then this isn't really the right strategy for you.
Right.
But if you want to just do something that's pretty simple and easy to understand and easy to follow.
Does Paul Tudor Jones have did he write a biography or?
Probably. I haven't researched that, but he probably has a couple of books.
Yeah, I don't know.
Yeah. Now that doesn't mean you can just, buy it and forget it.
No, of course.
You do have to watch. You do have to watch to see where it is. But right here, this is a 18-month view.
Yeah, but think about that: 8 trades in whatever it was, 14 years or whatever.
8 trades in 13 years.
13, yeah.
And 25% a year.
That doesn't suck
on average.
There's something there.
And very few drawdowns.
Yeah. Yeah. One even and one loss.
Yeah. There was one negative and one was even, 0.
Yeah.
So this is a closer view, 18-month. So if you look at this, whenever this is green, that means the 21 day is above the 50-day.
Okay.
And the dotted line is the 50. So the 21 day is above the 200. The 200 is the red line. The blue one is the 21-day line, and the green tells you that the 21-day is above the 200.
Got it.
So when it turns red, that means the 21-day dropped below the 200.
There you go.
So my idea that I put in the newsletter was, well, how about selling as soon as it closes below the 200?
The 21.
No, the 200.
What's below the 200?
Sell as soon as it closes because the 200 is what we're using for our trend.
So just the 200. So the 200 is the bar, and you're saying the daily close. Got it. Okay.
200 is the red line.
Yep.
This bar is the daily candle.
Got it.
So because it's a solid red one, it means it closed down here.
All right. So you'd sell there.
So you would sell on this day, roughly at 4,400.
Okay.
And then you would wait. And my idea was to use the 21-day to get back in. So you don't buy when it goes back above the 200, which would have happened right here.
Okay.
You buy after the 21-day has gone below the 200, and you don't buy again until it goes back above it.
Oh, so you're still out.
So you'd still be out. You would have been out right here, and you would still be out.
Wow.
It has still not gone back above the 200.
Understood.
So you would have been out for this whole period right here. Now, this can also work on an individual stock. Any particular stock you want to look at?
Yeah, let's look at Tesla.
Oh, that's a good one.
Everybody loves Tesla.
Tesla. So first thing you'll notice is that Tesla is still below, the blue, the 21 is still below the 200-day.
Okay.
So it has not given a buy signal yet.
Mm-hmm.
The sell signal would have been back here. You would have sold here.
Okay. Yep.
And you might have got back in right here because the 21 went back above the 200 right here.
Okay.
So you might have bought again here
Mm-hmm.
at about 300. And then it went up and it closed below the 200-day right here,
Mm-hmm.
about 295. So that would have been about a $5 loss.
Okay.
And then it continued down and it has not yet gone back above and given a buy signal.
Okay.
So, but back here, you can see.
Yeah. Well, let's do one more. Let's do Apple also.
Okay. Yeah, that's a good one. So there's Apple. So Apple, way back here, even though it touched the 200, it actually never closed below it. So you would have been in Apple through this whole period.
Okay.
Oh, when all this is green until
March.
right here.
Yep.
It closed below it right there at 150.
Mm-hmm.
All right. And then it went back above, and you might have got back in here.
Okay.
And then you would have been out again here. So there would have been a small loss right there.
For sure. Yeah.
But this exit right here would have been way back here.
Yeah.
So you would have had a huge gain on this one, and then a small loss on this one.
Mm-hmm.
And then you would not be back in. Actually, it went through right here. You would have been back in right here.
Okay.
Now with this one, with Apple, interestingly, there has not yet been a sell signal. So because it hasn't closed below the 200 yet.
We will see Monday.
It'll be interesting to watch this to see what happens.
Okay.
Now, anything like this, any mechanical system like this is not going to be perfect all the time.
Of course.
And especially when it gets close to a trend change, it's had a huge trend all the way through, going way back here.
Yeah.
When it gets close to a trend change, you're going to have a whipsaw action where it goes back and forth.
Absolutely. Okay.
So you may need to use other indicators.
Yeah. This is just for fun.
See if it makes sense. Yeah. You could use the PPO down here. Yeah. This probably still would have gotten in here. And then out here, but you may not have got back in again.
Okay.
But this one here into this period probably would have been whipsawed and had a small loss.
Yeah. Very cool. Well, this is a lot of fun. I thank you for bringing us new ideas. I love that idea of using the ETFs and doing 8 trades in 13 years. Sometimes people overcomplicate things.
Yeah. Well, it depends on what you want to do.
Yeah,
you want to,
of course,
be trading all the time, or if you just want to watch your money grow.
There you go.
One last thing,
sure.
Just out of curiosity, we've done this before, but these are the relative strength charts using the sectors. And a lot of times, usually a couple of times a week, I'll just flip through these to see what the sectors are doing. And what I'm looking for, this one here happens to be the consumer staples. So the pink line here is the 8-day. And I want to see this crossing up.
Okay.
Because that will mean that it's outperforming the S&P.
Okay. So
it's this staples versus the S&P.
That would be an early signal of rotation.
That's an early signal of rotation that institutions are moving back to
staples versus discretion.
Staples or value stocks instead of growth, or moving out of growth and moving
out of growth. Yeah.
Defensive. This is a defensive sector.
Yeah.
Okay. You can see it's actually started going up back here. And there's the S&P. That's where the S&P turned over.
Nice. Okay.
We can look at let's look at energy. See, energy was out of favor for most of this year.
Yeah,
and now it started to come back into favor. So this is a way to identify a sector, starting with the high level. What's the market doing? Right now it's going down. What are the sectors doing? I showed you that one before. I showed energy leading, right? And then what are the industries within that? So we can see here that energy is starting to lead, starting to outperform the S&P.
Yeah.
So that's probably an area that our next step would be to go look at the industries that are outperforming. And I already know that solar and renewable energy is the sector that's doing really well there. So that's where you could go look for stocks.
There you go.
Let's look at technology. So you can see right here from the bottom in June, technology had already started to climb higher slowly.
Mm-hmm.
And then in July, it took off.
Yep.
All the way up here, but now it's rolling over.
Yep.
Now it hasn't really crossed these other moving averages yet.
Right.
So it'll be interesting to see what happens.
Well, this is why we talked in video number 1. You're going to be flat for the week. You're going to it's very choppy, very noisy.
Because it's too there's too many unknowns.
Yeah.
You don't really know what's going to happen. It's
how big do you think Friday's number is going to be? The jobs number. You think it's a big day?
I think it's going to be, I don't know if it's going to be double like last time.
But it's an important number.
But it's a really important number. Yeah, it's going to give the Fed more ammunition to keep raising.
I think so.
Maybe go to 75. I said 50. I used to say 25. Now I'm saying 50.
Yeah, and I used to say 50, now saying 75. Yeah.
Right.
Okay.
And then the other one is consumer discretionary, which is also a growth sector.
Mm.
And you can see that's starting to roll over here too.
Yeah. Very cool. Well, Dan, let's close on your newsletter because you take a lot of time to put this out. It is free to get, also free to be removed. Something I look at.
No, you have to pay to be removed.
You have to pay to be removed. Genius. That's a marketing ploy. He's kidding, folks. That was a joke. Breakpoint trading.
I just thought of that idea. I might implement that.
There you go. It's free to get, but you got to pay to be taken. We're just kidding. Breakpointtrading@gmail.com in case you were listening on the podcast. Dan, I appreciate you every week. Folks are loving what you're doing. Thank you very much. Take care.
Yeah, I think the general idea that hopefully you got from these videos this week is that there's too much uncertainty. It looks like the market's going to continue down, but we don't know how far down. We don't know if what Powell said gets baked into the price and it starts to reverse. We don't know. We don't know anything yet. So it's better just to step aside, get out of the way of the freight train,
and just
make sure your stops are in, number one. Make sure you have stops. If you do have stops, you probably got stopped out a lot Friday.
Yeah. Friday was a bad day. Yeah.
And that should actually make you feel good.
Yep. Know your loss. Now you're out.
But it's better just to step aside and see what happens.
There you go. Well, Dan, thank you for the wisdom. Thank you for the help. Folks are loving it. I'm learning. I appreciate you, man. Thanks.
You bet.